Hey everybody, this is Brant from Wolf on Wall Street Trade. This is a follow-up video from last weekend's video. Things worked out pretty well. This is what the S&P 500 looked like as of the Friday's close before last weekend's video. A trend of lower highs, lower lows in the S&P 500. And we were looking at what it might take to get a bounce here, a decent bounce that was tradable. Check out the video from last weekend if you have time. If not, I'm going to play about a 1-minute clip that has the pertinent parts from last weekend's video. Here we go. And here's QQQ, the one chart of some interest. We are getting a slight relative positive divergence, definitely something that we're watching very closely. So beyond the lower highs, lower low trend, the area I'm kind of watching in the NASDAQ 100 is about this 20,800 level. If we see this 2,800 level hold and we start seeing some more buying, so like another test of this level. We have like a test here, we have a little lower low, but a successful test. Maybe we get another test and 3C starts picking up a little bit. We'll look for a bounce. I think probabilities are that it would be a tradable bounce, but I also think probabilities are that it would be to another lower high within this kind of developing sub-intermediate downtrend into the new year. We have a similar level with the S&P 500, even though we did make lower lows, lower highs. It's right around 58.30, 58.35 in that area. We'll look into next week, see if there's any improvement in those short-term 3C charts and bounce to a lower high. And that would be a place where, again, you could trade this on the long side for like a quick swing trade and then again down to the short side as we make a lower high. Okay, and here's the S&P 500 rolled forward. So this is this week starting right here. And you can see price held right up around that 58.30 level and we got a bounce to a lower high, as you can see over here with the NASDAQ 100. Same thing, got a bounce right over here to a lower high. And this is the trend line that I drew in for subscribers, a rough target of where I thought the NASDAQ was going to go on this week. So here it is holding up at 2,800 into the start of the week. Here's the bounce right into this trend line, lower high. And if we look at the Dow, had some pretty good price action there. In this case, and it's kind of important, we have this downtrend and the Dow is breaking the downtrend. So here is this week over here. It's a 30-minute chart and here's the bounce in the Dow. Some interesting things happening here that I'll get into. A little bullish consolidation. Here's Friday, breaking out of that. Dow's up 3.7%, so it outperformed the S&P at 2.9 and the NASDAQ at 2.85. But the big winner, again, and this is interesting because the S&P and the NASDAQ are really heavily weighted towards those mega caps where we have a more cyclical value feel in the Dow and especially in small cap IWM. And what I was talking about in last weekend's video, because as of that point, we were right over here breaking down from this bear flag. And we were looking for a false breakdown or a failed breakdown. So false or failed breakdowns often lead to fast reversals. You can see we got that this week with a 4% move. If I go to a 15-minute chart, you can see here's Monday. We hold this level, little bullish consolidation, almost a perfect small compact bear flag or bull flag rather, and a breakout from that on Friday. So it leaves us in an interesting place as we ended the week. I want to talk about the cyclicals because as I was just saying, we're getting a more cyclical feel rather than that mega cap secular growth. So let's take a look at a couple of subscriber posts over the last month or so. Here's one from December 13th. I was looking for this a while back. Let me get to the point that's important here. My gut feeling is that the market, dumped some of these mega caps right into year end, which is exactly what they did. If we look at the NASDAQ 100, which is mega cap heavy, here's that window dressing in December and right into year end, dumping them, or MGK for the mega cap index into year end. This is the FOMC, so that's 5 days after I posted that, we start seeing the mega caps being sold into year end, into the new year. Let's get back to those posts. The next one, this is just an intraday post. You can see it 3:15 p.m. on December 31st. And this is what I was saying. I have had a feeling that we do see rotation to small and mid caps, which is not something we've generally seen. It's all been mid cap. Cyclicals and value, which are going to favor the small cap IWM and to a lesser extent the Dow at the start of the new year. But that's a gut feeling. That's because I didn't have any evidence on the charts. So my gut feeling, which I haven't expected to see before the end of the year anyway, because of that window dressing, everybody buying the mega caps, the stuff that worked all year. So when they offer a prospectus to new clients see what they were holding as the end of the year and said, oh, you're so smart, you had all the right stocks. That's window dressing. But we did need a spark to get this rally going. I think bonds were already set up to get a major short squeeze. We saw that on 3C charts. And the spark was, well, the U.S. had some good economic data this past week, both hard and soft survey data. And that good economic data news tempered in the Treasury market that had the 10-year yield up at 4.81% at the high of the week and ended down at 4.61%, 20 basis point drop. The majority of that came from the CPI report. It really moved the needle. So here is CPI headline on month-over-month basis. You could see inflation is increasing again. So CPI over here came in as expected, but higher. And CPI on a year-over-year basis, what I've been talking about in a few videos, and subscribers know this, we did have a bump in inflation the first quarter of the year, and it started coming down. And then progress on inflation stalled in September when the Fed cut by 50, and we've been seeing this bump. So on a year-over-year basis, CPI is at 2.9%. But what the market got excited about was core CPI, which strips out, what they consider to be volatile energy prices and food prices, which are, people's everyday prices more than anything. So core CPI, instead of coming in at 3.3% as expected, it came in at 3.2%. That sent bond yields lower. That sent stocks higher. So that was kind of the spark, the catalyst the market needed. The market was ready to bounce. It was just looking for a reason, a spark. The market's response, with the S&P up almost 3%, small caps up over or about 4% for the week, was really a little overdone. It was a little bit stronger than the report itself. And then we had the Fed's Waller, who saw that CPI data and started talking about seeing the potential for more rate cuts in 2025, which of course the market loves. So you can read what he said down here if you want. You can pause the video. But this was just the huge catalyst that lit that little powder keg and sent yields sharply lower. Again, I think it was an overreaction, and the CPI data is not catching, just because of the timing when the CPI was taken, it's not catching these big moves in energy recently. So for example, this is a 4-hour chart of WTI crude oil futures, which were just chopping around real ugly. Then we got this triangle. I was like, okay, well, something might be getting ready to happen. This is the breakout over here, and as you can see, it's like late December, and it's just not reflected in headline CPI. So inflation is likely going to come in hotter on the next report, and then the market's going to be worried again. Point is, a little bit of an overreaction, but that's what we needed to spark this. Here's a 2-day chart of the 10-year yield. So this is where the Fed cut in September. And since then, they've cut 100 basis points. The 10-year yield has risen over 100 basis points over the same period. So this is really odd to see. Usually the 10-year yield would move lower with the Fed cutting rates. So I think it's screaming two things. One, that inflation has picked back up since September at the low. And two, that the Fed made a policy mistake. Oil prices have a lot of influence over yields. Oil, just commodities, but oil specifically, it flows into everything. So if I add USO for oil onto the 10-year yield, let me show you what I'm talking about, why I think the market had an overreaction to a slight miss in core CPI. So this is a one-day chart of the 10-year yield in the red and green candlesticks and USO for oil in blue. And what you'll see, lower high in USO in oil, and it leads yields lower. Over here, higher low, it leads yields higher. Lower high, it leads yields lower. It's about maybe a 1 to 3 week lag, a big lower or a higher low over here. This is where the Fed cut. This is where 10-year yield jumped over 100 basis points while the Fed has cut by 100 basis points. Not normal. But if we take a closer look at this week, at what happened, this 20 basis point plunge over here that allowed stocks to rally. And now we're looking at a 15-minute chart. So here's where we started the week. Here's a 20 basis point drop in the 10-year yield. And oil is leading yields back higher. Oil led yields to break out of this ascending triangle consolidation. So this is why I think, the stock market is looking at that slight miss in core CPI. It's rallying, expected, it's fine, but don't, delude yourself and think that with oil prices rising like this, that we're not going to see yields just jump back up in the next few weeks probably. What we're watching really closely right now is industrial metals. This is CPER, so it's basically an index fund for copper. I could pull up futures, but I think this is like a little bit easier to see. In any case, another big triangle, and you can see that copper prices have risen about up to here, we'd say, almost 11%. Again, inflationary. If copper breaks out above this triangle and we keep seeing oil trend higher, we're going to have a more serious inflation problem than we have. And everything that Waller said, you could just forget. We're going to go back to hawkish comments from the Fed, which the market is not going to like. And just to show you how much those 20 basis points of decline in the 10-year yield, the short squeeze in bonds, actually meant to the market, here I have S&P futures, 10-minute chart. They are in the candlesticks, and the blue line is 10-year Treasury futures. So yields move opposite of Treasury prices. So here's the CPI report Wednesday. You can see Treasuries short squeezed, yields plummet, and you can see the market moving, S&P futures moving right along with the 10-year Treasury, or opposite inversely to yields. That rotation I was talking about, that I showed you clips from subscriber posts about, my gut feeling that we were going to see value and cyclicals bid up into the new year. Here's the growth style factor in red, the value style factor in blue. December 2nd. So this is when we got the window dressing. Everybody is buying mega caps. It's basically sell everything, buy mega caps. Secular growth rising while value is falling sharply. And then here is this week, we start to see value outperforming growth. As a matter of fact, value was up 4.3% this past week, while growth was up 2.2% from right over here. This is not the norm at all. As a matter of fact, here's the growth style factor, and relative to value, so on a relative strength basis, you see value has just plunged. It has not done well. During Trump's first election, you can see a little bid in value over here, but otherwise everybody's just been buying mega caps. So it's an unusual thing to happen to see growth underperform and value cyclicals outperform. But that is exactly what we saw this last week, what I had a gut feeling that we would see, and those sectors perform so much better. As far as the 3C charts, and 3C is my proprietary indicator, money flow indicator, it has the power to contradict price, so we look for divergences or confirmation. So coming into this week, this is QQQ, and here we are coming into the week. I said we were going to be looking for 3C to improve. So as price pulled back, we could see accumulation. We could see them buying the dip over here, and here is our bounce, our rally into the end of the week. A little bit weaker Friday. That might be because there's a 3-day holiday. It might be because of the Trump inauguration. But in any case, it's not horrible, but it's something we're watching as we hit that trend line, the lower high in the NASDAQ 100. The SPYs chart is a little bit different. I only have 13 days of 1-minute data, but it has been trending down. 3C has been trending down since like mid-December. If you look at last weekend's video, you'll see it. But as we came into this week, at least we got a little bit of confirmation, moving in the same direction. Did not, move all the way up and confirm prices up here, but we got enough for the bounce. Here's IWM's 3C chart, negative divergence right there. As far as coming into this week, positive divergence right in here. You can see the low. We're testing a lower low, and we are seeing buying into that. Here's the little bull flag I was talking about. So not horrible confirmation, not the best in the world. What I do find interesting is if we take like a little bit longer perspective. So this is kind of like the detailed stuff we're trying to figure out, is this low being bought? But if we look at a trend, the 3C chart on IWM looks much better. You can see we started to get a positive divergence here into this week over here. Keeps on going. Nice positive divergence. A big change in character for an average that is really more tilted towards cyclicals and towards value. If we compare this to QQQ, we have a very different look where 3C is still trending down. So that tells me there is some rotation going on from the secular growth, like mega caps, tech, all that, into the cyclical pro-growth sectors and value, stuff that's gotten beaten up and just has not performed well. So this is kind of the Trump effect, which is why I had a gut feeling it was coming back in December. But a big difference between the two. The oversold conditions that we had, S&P 500, this is a breadth oscillator. You can see these oversold conditions, below like 10, 15, going on for quite some time. It's actually not too bad because it kept alleviating like intraday or day to day. It would alleviate that oversold. Sometimes we just stay pegged here, and it's a really dangerous place to be shorting the market. This wasn't as bad, but as you can see, we've now alleviated those oversold tensions with this past week's bounce. I think these rising rates, this is where the Fed cut, by the way, the first cut right here, and we've seen nothing but the 10-year yield rise ever since then. I think these rising rates are the primary risk moving forward. 10-year treasuries are the bedrock of the financial asset system for the global economy. The primary collateral in the ecosystem, whether it be banks, setting rates. So as rates rise and bond prices fall, it can create a situation where you have basically a global margin call. I think that's a big reason that China has been buying gold, trying to offset or hedge their treasury holdings. In the first quarter of 2023, we had some banks blow up at 4% rates over here. We're heading towards 5% rates up here. What happens then? I'm not getting into politics at all, have no interest in it. I do have to consider the politics of how it's going to affect the economy, how it's going to affect the stock market. And, just to be blunt, Trump's policies aren't nuanced. He's not like a tack hammer, he's like a sledgehammer coming in with policies. And we're in a time of kind of a complex financial situation where we have been seeing inflation come down, but we're getting bumps and we're getting bumps. And if you look at the late 1970s, early 1980s, big spike in inflation. The Fed basically cut rates to try to ease a recession that was taking place. And that caused like a double spike or double peak in inflation, double dip recession. They had to raise rates again. And at a time where bonds are falling apart, despite the Fed cutting rates, you know that Trump is going to want to run the economy even hotter, which will, on its own, push rates up. So the Fed may be faced with a choice of saving the bond market. Actually, it wouldn't just be the bond market, it would be banks as well. They would have to remove liquidity to do that. And when you remove liquidity, when they remove liquidity, they risk blowing up the stock market. Do I think they're going to do that? Absolutely not. But will they come out in 2025 and basically threaten higher for longer or even mention rate hikes? I think they will do that. I think they will try to talk yields down to save the bond market. That will make for a very choppy stock market in 2025, or what I have said I think is going to be a trader's market. Yields keep moving up like this, high valuation stocks are going to get hit hard. Small caps don't like higher yields either. But this is just stuff we're going to have to take as it comes. We don't know what Trump's policies are going to be, when they're going to be passed. I think, he could have a pro-growth policy that would be very effective in one time frame. But if inflation is trending up, it could be disastrous in another. There is a lot of nuance to this, and Trump doesn't do nuance. In the near term, of course, the market is closed on Monday for Martin Luther King Day. We have seen the S&P 500 make that lower high, which you can see over here. It's over the trend line, but it is a lower high, and the NASDAQ 100 right at that trend line, another lower high, which is what I forecasted last weekend in my video. If we can hold up around 20,800, we can see this bounce to a lower high. As I look at small caps though, and you saw the 3C chart, which did not look bad, we do have this bull flag over here, and it has not met the measured move. Even though prices kind of drooped down over here on Friday, this is still a bullish consolidation. So I think we could have some more upside. I would think actually because of this false or failed breakdown, we'll see a fast reversal and come back above this. It's kind of like my channel buster theory where prices break down over here and they usually run right back up to the other side, kind of like a slingshot or a pendulum swinging. So we'll be watching small caps and the 3C charts early next week. I'm sure Trump is going to come out with a number of executive orders Monday afternoon, but looking pretty good here. I do think we could see some higher prices, and I do think we can see more of that rotation that we're starting to see finally to value and to cyclicals and away from the mega caps. Do I think it's going to last in a late economic cycle as far as the yield curve having inverted and now steepened sharply? These are kind of the wrong stocks for that. But if we see continued rotation into them, do I think that they can hold up and do well for a quarter? Yes, I do. And that will give us a little time to kind of assess Trump's policies, what they do, what rates do, what the Fed does, how the Fed reacts. I think Trump is going to troll Powell nonstop every single day, looking for lower rates, which when you have a bump in inflation, that's not the policy you want to pursue if you're the Fed. In any case, we got what we were looking for, and we got some really good tradable moves this week in the averages, anywhere from 2.85% all the way up to 4% in a week. That's small caps right here. So we'll pick it up next week and see where we go with that. Keep an eye on 3C. And subscribers, obviously, you'll be the first to know with any kind of changes. If you're not a subscriber, check it out. You get all of this information in real time every day that the stock market's open. If you like the video, please give it a thumbs up. Don't forget to subscribe to my channel and hit notifications so you know when the latest video is coming out. I generally check in when something big is happening in the market. Everybody enjoy your weekend. Happy Martin Luther King Day, and subscribers, I will see you on Tuesday.